Today, we will talk about earning through options trading. Options trading is the process of buying or selling options contracts, in which the buyer purchases the right to buy or sell an underlying asset at a predetermined price, known as the strike price, at or before a specified date, known as the expiration date. The option contract seller agrees to sell the underlying asset at the strike price if the buyer decides to exercise their option to buy it on or before the expiration date. 1. Covered calls. Covered calls involve owning the underlying stock and then selling or writing call options on that same stock. This strategy allows the stock owner to generate additional income from the premiums collected from selling the call options. If the stock price remains below the strike price of the call option by expiration, the option will expire worthless, allowing the stock owner to keep the premium and retain the stock. However, if the stock price exceeds the strike price, the stock might be called away. Covered calls cap the upside potential to the strike price plus the premium received, but offer downside protection to the extent of the premium collected. 2. Protective puts. Protective puts involve purchasing put options on a stock you already own. This strategy acts as an insurance policy, safeguarding the stockholder against a significant drop in the stock's price. If the stock price falls below the put option's strike price, the value of the put will typically rise, offsetting the loss in the stock. Conversely, if the stock price rises or remains stable, the put option may expire worthless, resulting in a loss equal to the premium paid. In essence, a protective put provides downside protection for a stock position, while allowing the investor to benefit from any appreciation in the stock's value. 3. Iron condors. Iron condors are advanced option strategies involving 4 different contracts. It's designed to profit from stocks that are expected to have low volatility. An iron condor is established by selling one out-of-the-money put and buying one further out-of-the-money put, forming a bull-put spread, while also selling one out-of-the-money call and buying one further out-of-the-money call, forming a bear call spread. If the stock remains between the 2 strike prices of the sold options at expiration, all options expire worthless, and the trader keeps the entire premium received. However, losses can occur if the stock moves significantly in either direction beyond the range set by the bought options. 4. Vertical spreads. Vertical spreads involve buying and selling call or put options of the same underlying security with the same expiration dates, but different strike prices. There are 2 main types: bull call spread, buying an at-the-money or in-the-money call and simultaneously selling a higher strike out-of-the-money call. This strategy profits when the stock rises but caps the profit at the higher strike price. Bear put spread, buying an at-the-money or in-the-money put and simultaneously selling a lower strike out-of-the-money put. This strategy profits when the stock falls but caps the profit at the lower strike price. Vertical spreads aim to reduce the cost of entering a position, as the premium received from the sold option offsets the premium paid for the bought option, while also defining potential risk. 5. Calendar spreads or time spreads. Calendar spreads or time spreads involve buying and selling 2 options of the same type, both calls or both puts, with the same strike price but with different expiration dates. The typical setup is to sell a shorter-term option and buy a longer-term option. The strategy aims to profit from the faster time decay of the near-term option compared to the long-term option. If the stock remains close to the strike price as the near-term option approaches expiration, the strategy can profit from the difference in time decay between the 2 options. Calendar spreads are generally used when little movement is expected in the underlying asset in the short term. 6. Straddles. Straddles are option strategies designed to profit from significant movements in the stock price, regardless of the direction. A long straddle involves buying both a call and a put option with the same strike price and expiration date. If the stock makes a substantial move in either direction, the strategy can be profitable. For instance, if the stock surges, the call option's value may increase, while the put option's value decreases, and vice versa if the stock drops. The main risk is if the stock remains relatively stable, both options might expire worthless, resulting in a loss equal to the initial premium paid. straddles are often used ahead of known events that may cause volatility, such as earnings announcements. 7. Strangles. Strangles are similar to straddles, but involve out-of-the-money options. In a long strangle, an investor buys an out-of-the-money call and an out-of-the-money put with the same expiration date, but different strike prices. The strategy profits when the stock makes a significant move in either direction. Because both options are out of the money, a strangle is generally less expensive to set up than a straddle. However, the stock must move more significantly for the strategy to be profitable. If the stock price remains between the two strike prices at expiration, both options may expire worthless, resulting in a loss of the initial premium paid. Strangles are used when an investor expects high volatility but is unsure of the direction. 8. Butterfly spreads. Butterfly spreads are neutral option strategies with limited risk and profit potential. They involve 3 strike prices and can be created using calls or puts. For a long call butterfly spread, buy 1 lower strike call. Sell 2 middle strike calls. Buy 1 higher strike call. The maximum profit is achieved if the stock closes at the middle strike price at expiration, and the maximum loss is the initial premium paid. Essentially, the strategy aims to profit from stocks that are expected to have minimal price movement. When set up correctly, the butterfly spread can result in profits if the stock remains near the middle strike price, while limiting potential losses. 9. Naked or cash-secured puts. Naked or cash-secured puts involve selling put options without holding the corresponding amount of the underlying stock. Naked puts, selling a put option without holding the cash to buy the stock if it's assigned. This strategy is riskier because if the stock drops significantly, the losses can be substantial. Cash-secured puts, selling a put option while setting aside the cash necessary to purchase the stock at the strike price if assigned. This approach is more conservative than selling naked puts. Both strategies profit from the premium collected when selling the put option. If the stock remains above the strike price at expiration, the put option expires worthless, and the trader keeps the premium. However, if the stock drops below the strike price, the seller may be obligated to buy the stock at the strike price, which could result in a loss. 10. Collars. Collars are protective strategies often used by stockholders to limit the downside risk of a stock position. A collar involves holding shares of an underlying stock while simultaneously buying a protective put and selling a covered call on that stock. The protective put provides downside protection by offsetting any loss in the stock price below the put strike price. The covered call limits the upside potential of the stock position, but its premium helps offset the cost of buying the put. What do you think of our video? Let me know in the comment section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.